Hello everybody, this is the quiz review video for job order costing, which is your chapter 19 quiz on Pearson. In this example, Warwick Tree Houses is going to build custom high-end tree houses, and they're going to use the job order costing system. This company is going to use direct labor hours as its cost driver, and for the month the company is going to estimate that the total manufacturing overhead for the entire business is going to be $140,000, and the total cost of direct labor will be $280,000. Well, right off the get-go, we have enough information to figure out what our allocation rate is. If we simply take our budgeted overhead costs and divide them by the quantity of the cost driver, it's going to give us our allocation rate. Our budgeted overhead costs were $140,000. The quantity of the cost driver is whatever Warwick Tree Houses is set. In their case, they use direct labor costs as its cost driver. So we know that the quantity of the cost driver is $280,000. And if we take $140,000 and divide it by $280,000, we get 50%. So for every job this company does, they are going to allocate overhead, which is all the costs that can't be directly traced to a job, things like rent, things like depreciation, things like insurance, all of those costs. They're going to allocate a portion of those costs to each job at a rate of 50% of that particular job's direct labor costs. Here's the information we're going to work our way through. Warwick Tree Houses is going to purchase $480,000 worth of material. They are working right now on 4 different jobs, and we have the direct material and direct labor cost for each job. In C, they are going to incur $200,000 worth of labor costs across all of the jobs. They're going to depreciate manufacturing equipment. They're going to pay some overhead costs. In this case, it's going to be rent expense and the expiration of prepaid insurance. They're going to allocate overhead to jobs. They're going to complete 2 of the 4 jobs that they're working on, and they are going to sell job number 4 to a customer on account. So we're going to work our way through all of this information to record these transactions in journal entry. The first item we have to record is the purchase of direct materials. So Warwick Tree Houses is buying $480,000 worth of direct materials. We're going to put these materials that we are purchasing in an account which tracks all of our raw materials sitting around waiting to be used in production. So since they build tree houses, there's going to be things like lumber, like screws, like shingles maybe. All of this stuff is raw materials. They're not being used yet in a job. They're sitting there in storage waiting to be used. The company purchased $480,000 worth, and they did so on account. So we're going to credit accounts payable for that same $480,000. We purchased materials on account. In B, we're going to record the requisition. So this is taking those raw materials out of storage sitting around and putting them into use in actual jobs that we're working on at the time. Well, when things are put into use on a job that you're working on, it's considered a work in process. And the account that tracks the amount of costs that have gone into jobs that you're currently working on is called WIP inventory. So we are going to put the costs of materials actually being used on jobs into our WIP inventory account. How do we figure that out? Well, we have 4 jobs, and we have the amount of direct materials that have been requisitioned to each of these jobs. If we total that up, we come up with $275,000. So $275,000 worth of materials were taken out of storage, out of our raw material account, and put actually into jobs which were a work in process. And I just said right there, we're taking it out of raw material. So our credit is going to be to raw materials inventory, reducing the value of that asset on our books because they're no longer raw materials sitting around. They're materials being used on a work in process. We recorded our material requisitions. Next, we have to record our labor costs. And this is going to be a little bit of a workaround to get there, but we're going to get there. Labor costs, just like materials, are an inventoriable cost, which means the cost of labor for people who are actually building these tree houses, we don't record it as an expense. We put the cost of their labor into the value of the inventory that we are working on. So we're once again going to debit work in process inventory. For how much? Only for the amount of labor costs that can be directly traced to jobs, or our direct labor. Well, we have 4 different tree houses we're building. We have the respective labor cost for each of those 4 tree houses. If we total that up, it's $180,000. which is a bit of a conundrum because in C, it clearly states we had $200,000 worth of labor costs, which means that's going to be what our wages payable is. Well, our debits don't equal our credits. We have a difference of $20,000. That difference of $20,000 goes into what they call manufacturing overhead. It is an account which pools all of the costs that can't be directly traced to jobs. How could we have $20,000 of labor that can't be traced to jobs? Well, it could be things like custodians that clean up the warehouse floor. It could be things like production managers who don't directly work on the jobs, they oversee everybody else is working on the jobs. They call this concept indirect labor, and the portion of indirect labor goes into manufacturing overhead. And with that, we have recorded our labor costs. In D, we're going to record depreciation. And the costs of depreciation for a company which produces its own goods doesn't get written off as an expense because it is a necessary cost of manufacturing the product. So instead, we're going to put it into that manufacturing overhead account. And manufacturing overhead is going to get debited for $6,600. The credit, however, still tracks the amount of value that equipment has lost, so we're going to credit accumulated depreciation of equipment for that same $6,600. We recorded depreciation on our manufacturing equipment. In E, we're going to pay more overhead expenses. We have two things. We paid a $32,000 rent expense, and we had the expiration of $3,000 worth of liability insurance. These are overhead expenses because we can't track them directly to the jobs. Take the rent, for example. We don't know how much rent can be attributed to treehouse number 1 versus treehouse number 2. Same thing with our liability insurance. We can't tell how much liability insurance got used up on treehouse 3 versus treehouse 4. These costs are indirect, and because they're indirect, we're going to put them in a pool, and we're later going to spread that pool amongst all the jobs that we did. And that pool, again, is called manufacturing overhead. We had $32,000 of rent and $3,000 of insurance, so that's $35,000 of overhead costs. For the prepaid liability insurance that's expiring, well, we must have had prepaid insurance on our books to start with. We need to decrease that asset's value by the amount that it expired, which was $3,000, and that rent that we had was paid in cash, so we need to decrease our cash account by that amount of rent, which was $32,000. We recorded our overhead expenses. So we've been pooling up these costs. We pulled up the costs of that indirect labor. We pulled up the depreciation costs. We pulled up the cost of rent, the cost of liability, all these untraceable costs. Well, now we need to put them into our jobs. And when we do so, it's going to go into WIP inventory. We're taking those costs out of our overhead pool and putting it into the cost of the inventory we have, which is a work in process. How much is it going to be for? Let's compute this. Our cost driver was our direct labor costs. We figured that out on the first slide. We also figured out what our allocation rate was. It was 50%. So if we take the quantity of the cost driver, which was our direct labor costs of 180,000, multiply it by 50%, we get 90,000. Why is it 180,000 instead of 200,000? Because that was the direct labor cost that we had. Yes, we paid $200,000 worth of labor wages, but some of that was for indirect. You only use the portion that is the same as your cost driver, direct labor costs. 180 grand times 50%, 90,000 goes into WIP inventory, and it comes out of that manufacturing overhead pool that we have been accumulating costs into. So that gets credited for 90,000, and we allocated out this overhead. In G, we are completing jobs 2 and 4. When you complete a job, you can't have it in WIP anymore because WIP stands for work in process. Well, we're done. It's not a work in process anymore. We finished it. So we need to transfer it out of our work in process inventory account into our finished goods inventory account. By how much? Well, let's figure it out. We completed jobs 2 and 4. Our information tells us that job 2 had $69,000 worth of direct material costs. It had $32,000 worth of direct labor costs. Well, we need to figure out the amount of manufacturing overhead we're going to put into job 2 using the same formula that we had before. Our cost driver, which in this case is direct labor costs, times our allocation rate, which is 50%. So for each job, we are going to allocate overhead equal to 50% of that particular job's direct labor. This job had $32,000 worth of labor, which means it's going to get half of that manufacturing overhead, or $16,000. And when we add that up, we realize that job 2, treehouse number 2, cost us $117,000 to produce. That is one high-end, very nice treehouse. Job 4 was the other one that we completed. It, according to our information, had $87,000 worth of material costs. It had $52,000 worth of labor costs. Manufacturing overhead is going to get allocated at a rate of half of our labor costs, so that's going to be $26,000. And job 4 in total cost us $165,000. So if we completed job 2 and it cost $117,000 and it's finished, we completed job 4 and it cost $165,000 to finish. Well, those two together is $282,000, which is the amount of finished goods we need to put on our books. And because it's finished, it is no longer a work in process. We need to take it out of our WIP inventory for that same amount. We recorded the completion of jobs 2 and 4. And then in H, we sold job number 4, and we did so on account for $240,000. And like any sale that a company has, you're going to have 2 entries: to record the revenue and to record the expense. So let's record the revenue first. We're selling this job on account, so we're going to debit accounts receivable for the sale price of treehouse number 4, and treehouse number 4 sold for $240,000. We're going to credit our revenue account. We sold something that we produced. It goes under sales revenue, also for $240,000. We sold job 4 on account. When we record the expense, we record the expense under cost of goods sold. We're selling something, and the amount that we're going to record this for is the cost that we had for job number 4, which we just calculated on the last slide. Job 4 cost us $165,000 to make that treehouse. We sold it, which means we no longer have it. And since we no longer have it, it can't be in our inventory because it's inventory that no longer exists in our possession. Somebody else has it, which means we need to take it out of finished goods inventory for its cost basis, $165,000. We recorded COGS on this sale. We sold job 4 for $240,000. It cost us $165,000. So what was our profit on job 4? It's just the difference between these two numbers. We made $75,000 off of building treehouse number 4 for this presumed millionaire that wants a $250,000 treehouse. So let's check the status of our 4 treehouses at the end of the period. Job 1 had $55,000 worth of materials put into it. It had $42,000 worth of labor, and it had $21,000 worth of manufacturing overhead. Again, for Warwick tree houses, manufacturing overhead is always going to be half of the direct labor costs. So that job cost us $118,000 in total. Job 2 was $69,000 of direct material, $32,000 of direct labor, and we allocated $16,000 worth of overhead. That job cost a total of $117,000. Treehouse number 3, $64,000 worth of materials, $54,000 worth of labor, manufacturing overhead equal to half of our labor costs, so $27,000. Gives us $145,000 in cost that we have in job 3. And then job 4, direct materials, was $87,000, $52,000 of labor, $26,000 of overhead. Job 4's total cost was $165,000. What is the current status of these jobs? Well, job 4, we completed. And not only did we complete it, we sold it. So we don't have that on our inventory anymore because we disposed of it. We sold it to the client that hired us to build them a high-end treehouse. We completed another job 2. In G, we completed job 2, and we haven't sold it yet. So that is a finished good that we have not sold to this person yet. So it's going to sit on our inventory at the end of the month as finished goods inventory. Job 1 and 3, we've been working on these 2 tree houses, but we haven't completed them. So both of those are considered to be a work in process and should be put on our books as work in process inventory for the costs that have gone into them so far. So our ending WIP is going to be $263,000. The $118,000 in cost we have in a job 1, and the $145,000 in cost we have in a job 3. Our ending finished goods is the cost of job 2, $117,000. We haven't sold it yet, but it is done, so it goes into ending finished goods inventory. Job 4 does not need to be on our books because we actually sold it.